Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be talking about a topic on how to grow your options trading account. And I'm specifically going to be highlighting one specific option strategy that I believe should be a central focus for anyone who's interested in utilizing options to grow their account consistently, regardless of whether you have a relatively large or small account, regardless of whether you're relatively new or an experienced options trader. This is the one strategy that I believe everyone should be focused on learning to improve their odds of success for options trading. It doesn't mean that you ignore other option strategies, but this is one that's quite flexible in nature, quite forgiving in nature, and applicable in a lot of different market environments, which is why I think it is one of the core strategies that everyone should learn how to utilize. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a recommendation or solicitation to buy or sell any of the specific securities. And also remember that options as an investment carries risk, and it's important that all investments include risk, including the potential loss of principal. Options trading has additional risk and is not suitable for all investors. So in today's session, we're going to focus on learning on how to grow an account, specifically what you need to have in place in order to grow your options account. And we're going to focus on the simple and forgiving option strategy that I believe everyone should, as an options trader, understand and utilize in their trading. We'll talk a little bit about what is the optimal version of that strategy, and specifically how to gain an options edge when you're trading this specific strategy, and how to gain a timing edge using the strategy. And then we're going to look at the tools you have available at First Trade that will provide you with a real-time scanner for this specific strategy that gives you both the options edge and the timing edge for you, done as part of your platform, so that you can find the best trading opportunities that you have learned from today's session using the tools that you have available at First Trade. And then at the very end, we'll talk a little bit about how to trade and manage these strategies. But the primary thing that I want you to be able to walk away from today's session is a clear understanding of how can you grow your options account consistently using credit spreads. So the strategy that we're going to be focusing today on is going to be credit spreads. So whether you are brand new to options trading or you have some experience trading, I'm going to walk you through what a credit spread is, how to gain an edge, and then more importantly, how to find these types of opportunities using the tools available to you here at First Trade. So let's first kind of take a step back and look at, what does it take to grow an options account? So there's a couple of things that I feel are central to helping investors who are struggling with trading or struggling with consistently growing your account to kind of reach the goals that you have. Number one, first thing you want to be able to do is gain confidence. And that comes down to fundamentally understanding how a strategy works, and specifically how a strategy can potentially give you an edge. If you don't have that understanding, it's hard to consistently grow your account, because if you're just following what someone else tells you to do and you don't really know why they're trading a specific strategy or why they're trading a specific way, it's going to be nearly impossible to consistently grow your account in the long run. So today, what I want to not only do is teach you the strategy, but help you understand how it works. The second thing you want to do is gain some consistency. You want to try to win at least more than 50% of your trades. Now, that doesn't necessarily mean you're going to be profitable, but what I tend to find is that when you are profitable in more than 50% of your trades, it gives you an extra boost of confidence and energy that makes you want to improve and get to become a better trader, because There are plenty of strategies where you can be profitable while only winning 30 to 40% of the trades that you place. But it's demoralizing for a lot of traders to lose on more than 50% of their trades. And they find it really hard to kind of find the mental energy and the ability to kind of focus on improving when they feel that they're so far behind. So the strategy that we're going to show you today, naturally on its own, has a win rate higher than 50%. Now, just because you have a 50% win rate doesn't mean you're profitable, but it is a good starting point for a lot of traders who are struggling with the mental aspect and the difficulty of struggling with trading. And then lastly, the most important part, arguably, which is preventing blowups. Having rules and discipline that can prevent blowups and prevent you from losing faith in the strategy. Because there are lots of strategies where you have winning trades more than 50%. You might even have a fundamental understanding of how the trade works, but because you are not following a disciplined rule for position sizing, you many times might find yourself blowing up. And a lot of times that actually is followed by that's following a string of winners. A lot of traders, what they do is they learn a strategy. They start trading it. Maybe after a while, they feel like they're getting a hang of it. They're getting a string of winners. They feel like, oh, this is really starting to work. And a lot of times what I've seen traders do is, they have a string of winners. They start adding to the size. They start trading much larger size than they were doing before, thinking that, oh, I'm starting small. I'm just learning. Once I feel that I got the hang of it, I'm going to start increasing my size. And they increase their size to far beyond what they should be trading from a risk perspective. And next thing they know, they have a few losing trades that blows up a large percentage of their account. And if any of you can relate to that, just think back about that, and we're going to reflect back on those strategies and specifically how you can avoid blowups in your account. Because no matter how good your strategies are, if you blow up your account, then all bets are off. So the simple and forgiving strategy that I want to cover today are credit spreads. Credit spreads are an income generating strategy for what is a mild directional view on a stock or ETF. What that means is that you don't necessarily have to have a strong directional view on a stock. You just have to be able to look at a chart and generally identify whether the stock is trending higher or trending lower. That's it. As long as it's trending in one direction or another, you generally have the precursor for a credit spread trade. Which means that you don't necessarily have to have a strong understanding of technical analysis or fundamental analysis or any other form of analysis or the ability to read the markets. If you can basically look at a chart and generally say, oh, this stock is trending higher, or oh, this stock is trending lower, that's enough information to potentially trade a credit spread. It's also a forgiving strategy. It's a strategy that has a higher probability of profit, which is going to help you build confidence. And lastly, it's a strategy with limited risk and limited reward. And what that means is that you have full control over how much money you can win and how much money you can potentially lose. So you don't ever have a true excuse to say, I lost too much money on a trade because I followed someone else or someone else told me to trade this credit spread. Because ultimately, the only person that has control over how many contracts you trade is yourself. So if you ever find yourself selling a credit spread and then after the fact say, oh, I lost too much money on that trade, unfortunately, the only person you can blame is yourself. And the only person that can fix that problem is yourself. So you have full control over how much money you can potentially make or lose on every single trade. And that's an important part in having the discipline to grow your account consistently in the long run, is to stay disciplined in your position sizing. Okay. So the credit spread provides you with all of these things. So looking at an optimal credit spread. An optimal credit spread is essentially when you identified a stock that's trending in a specific direction, what you do is you apply what we call the optimal credit spread. And the optimal credit spread is going out roughly 45 days from expiration. So as you can see right now, Merck's is trading at around 101. Looking at the 45-day expiration, we're roughly going out to January expiration. And what we're trying to do is we're trying to sell the at-the-money call or put, depending on whether we're bullish or bearish. And then we're buying an out of the money call or put against that. We're specifically buying the 25 delta call or put. So we're always going to sell the at the money. So when Merck's is trading at 101, we're going to sell the 101 puts, the at the money put option, and we're going to sell the put option because we're bullish, right? So if whenever we're selling, puts are going to be bullish, calls are going to be bearish. So in this particular case, because the stock is trending higher, we're going to be selling put options, and we're always going to sell the at the money put. So because the stock's trading at 101, we'll sell the 101 put option, and then we will buy a 25 delta put against that. A 25 delta put is specifically a strike price that has a 25% chance the stock will be below $96 at expiration. So when you're using your OptionsPlay platform, or when you're using any other platform, I'll show you how our tools identify the specific expiration dates for you automatically, so that you don't necessarily have to memorize all of these things and do it manually. Our tools will actually apply these things for you automatically. But if you were to structure one of these trades manually on your own, our tools provide you with the ability to structure these, because as you can see, our tools, when on every single strike price, you see there's the 94 strike has a $2.74 premium, and there's a number next to it. That tells you the delta of the strike. So the 97s have a delta of 25. The 96 have a delta of 21. So what that means is that the $97 strike price, meaning based on the current price of stock of 102.50, there's a 25% chance the stock will be below 97 bucks, a 21% chance the stock will be below 96, a 17% chance that the stock will be below 95. So we always want to take a probability-based approach when we're selecting our strike prices, because if we can take a probability-based approach, that's how we're going to generate a much more consistent strategy and much more consistent outcome for our strategies. So that's why we always sell the at the money call or put, and then buy a 25 delta call or put against that. Now, if you follow these specific rules, setting using the target expiration date and strike price, the rule of thumb is that you want to collect at least 1/3 of the vertical width in order for this to be a strategy that's worth trading. So what does that mean? The distance between these two strike prices, the 101 and 96, that's what we call the vertical width of the credit spread. So the distance between 101 and 96 is $5. So the rule of thumb is that you want to collect 1/3 of that, which is going to be $1.67. So as long as you're collecting $1.67, you're going to be, that's the bare minimum that you want to collect on a credit spread like this. In this particular case, you're going to collect $1.91, which is more than the $1.67 minimum that you want to collect on a credit spread like this. So before we go any further, I want to make sure that we understand a few different numbers. Whenever we're trading a credit spread, the distance between the two strike prices, that's going to be the maximum dollar amount that is at play in this particular strategy. What that means is that whatever you collect in this particular case, if when you collect $1.91, the distance between the two strike prices, the $5 minus $1.91, tells you how much you have at risk. So if you can collect $1.91, then the total risk on this particular trade is going to be $3.09. So the relationship between the risk and reward is inverse, meaning the more you collect in potential reward, the less you are going to risk, which is why we have a minimum width, because we want to have a minimum amount that we're collecting, which then states what is the maximum that we can potentially lose. So just to kind of help you better understand this. When we're looking at, sorry, this is actually, I have a typo here. This should be $1.67, and this should be $3.33. So sorry, there's a small typo here. So in this example, we're selling the 101 put, and we're buying the $96 put. What that means is that the distance between these two strike prices is $5. That's what's at play. So the minimum that I'm saying that you want to collect is $1.67. Because if you collect $1.67, then what that means is that if you collect $1.67 of the $5, then what's left of it is going to be $3.33. That's how much you have at risk. That's why we set this minimum, right? Because if you collect at least $1.67, your minimum risk to reward is going to be $2 that you're risking for $1 of potential reward. So if a strategy that you have like this, where you're selling the 101 put and buying the $96 put that you're collecting $1.67 for, your risk to reward ratio is 2-to-1. That means if you have two winning trades that you win $1 for and one losing trade where you lose $2, you have two winning trades where you have win $1, one winning trade where you lose $2, and you keep repeating that cycle over and over again. What you get to at the very end is a big fat zero. And a lot of people will ask me, why would you ever trade a strategy where the expected outcome of the strategy is effectively zero, right? You're not making any money on this. Well, my answer for a lot of traders is that most traders are not even at break even. Most traders are still struggling where they can't even get to break even. They're losing money week after week, month after month. So the first thing we want to do is we want to set a floor. We want to make sure that you don't trade strategies where the expected value is less than zero, so that you can, at the very least, get yourself to break even. But the real goal here with these types of strategies is obviously not to break even. We want to try to make a profit. And that's why we say we want to select option strategies where the minimum premium that you're collecting is 33% of the width, or 1/3 of the width. But in the example that I gave you here, we're collecting not just $1.67, we're collecting $1.91. And when we collect $1.91, what that means is that our risk is reduced from $3.33 down to just $3.09, which might not seem like a whole lot, but what you're now getting to is a risk reward that's approximately 1.5-to-1. And what that means is that for the same stock, with the same potential opportunities for the stock, you're now, for every two wins that you have $1 winning for, and you have one trade that you lose $1.50 for, two winning trades where you win $1, one losing trade where you lose $1.50, and you repeat that cycle over and over again. Now you have an expected positive outcome, and you require fewer winners in order to break even. So that is the goal that you want to achieve when you are selling a credit spread, is you want to maximize opportunities where you can collect the most amount of income as possible, because that's going to reduce your overall risk on the trade. It's going to improve your odds of success and improve your risk to reward on your trades. So that's the first step in developing a strategy that can help you grow your trading account, is finding credit spreads where you have a directional view on a stock and you can sell a credit spread where you are collecting more than 1/3 of the vertical width that is going to improve your odds of success on the trade. So this is what I'm referring to in terms of gaining an edge on the options trade. Okay, that's the first step. The second step is you want to gain an edge on the timing of it. Because if you look at a chart like this, right? Like I said before, if you can look at a chart and generally see that the stock is either trending higher or trending lower, that's really the bare minimum of what you need in order to sell a credit spread. What that means is that you could have sold a credit spread in almost any part of this bullish trend and potentially have been able to turn a profit. even if you enter the trade at what we consider as somewhat suboptimal times. Let's say you entered a bullish credit spread at where I've pointed the arrow to. Well, what that means is that, you very well could have turned a profit on the credit spread eventually, but chances are you would have had to sit through a few weeks, potentially even a little bit longer, of small losses, small gains, small losses, small gains, eventually before the stock kind of turns higher and you turn a profit on your credit spread. There are maybe a few extreme examples where even with the worst timing, you would have turned a loss. Let's say you would enter the trade right here, and then immediately the stock drops so much that even after a few weeks, even a couple of months, the stock is still trading below where you are before it turns into a profit, meaning it took too long to recover before you turned a profit. But most instances, right? If let's say you had entered the trade, let's say here instead, you would have sat through a little bit of chop, but within a few weeks of time, the trade would have turned profitable. So even in some of the worst case scenarios, right, where you bought kind of near the very top and then the stock kind of consolidated for multiple weeks before it continued moving on, you would have been profitable with these types of strategies. It just would have taken you a while to get there, and you would have had to sit through a few weeks of small gains, small losses. Might not be comfortable, and it's never a comfortable position to sit in a position where one day you're up a little bit, the next day you're down a little bit, and next day you're up a little bit, next day you're down a little bit, and you don't have a strong directional outcome from that particular trade, right? Versus if you look at kind of this uptrend, there are a few opportunities where if you entered at the more opportune times, which is the times where I've shaded here in green, if you had entered at the time where we've highlighted in green, you would have been profitable pretty much from the day you entered the trade, and you would have gotten out at a profit in a very short amount of time, right? So meaning if you had waited, if you had been patient and waited for where I've shaded it in green, you would have been profitable very quickly. You would not have to sit through a few days or a few weeks of small gains and small losses, and you would have immediately turned a profit and been able to get out of the trade probably within 2 to 3 weeks maximum. So the question is, how do you gain an edge from a timing perspective? Well, if you look at any uptrend, an uptrend is not just a straight line to the up and to the upside, right? There are peaks and valleys. So what you generally want to do is you want to look for pullbacks inside of a bullish trend. And there are many small pullbacks inside of a bullish trend. And so even within this bullish trend, I can probably identify nearly a dozen, small pullbacks that have opportunities to be a buyer where the trend would have been where the timing would have been more favorable. So that is really how you want to be able to truly become a better trader. If you're trying to optimize your ability to grow your account quickly and consistently, you want to do both aspects as well as possible. The first step, which is gaining an options edge on the options trade, and then you want to try to gain an edge from a timing perspective. And timing works both ways, whether you're looking for a bullish opportunity or a bearish opportunity. When you're looking for a bearish opportunity, what you want to do is you want to find stocks that have rallied inside of a bearish trend, right? So as you can see in this bearish trend, there are 1, 2, 3, 4, 5, 6, plenty of bearish opportunities where the timing is even better to add some bearish opportunities. So this is really where we are trying to do our best to find where we're trying to optimize the timing on these types of trades as best as possible for our trade entry. So when we're able to do both parts, where we're optimized from the options trading perspective and optimized from a timing perspective, that's when we can get the best results from this type of strategy. All right. So now that begs the question, right? We now have an understanding of credit spreads, what they are, how they're structured. We have an understanding of what constitutes as an optimal credit spread, and then we also understand what constitutes as optimal timing. But then that begs the question, how do we find that? But before I answer that question, how do we find stocks that are where the timing is most optimal and we also have the most optimal option strategy? Let's talk a little bit about actually let's actually jump into that, right? Because I've taught you all these different things of what to look for. The question is, how do you actually find it? Well, that's when we built this directly into the tools that you have available to you here at First Trade, which is the OptionsPlay Trade Ideas section. So under the OptionsPlay Trade Ideas section, under the ideas section, there is a specific category of ideas called credit spreads. And the ideas that are presented to you under the credit spread section are specifically going to be credit spreads that only generate more than 33% of the vertical width. So we already have filtered out thousands of opportunities where the vertical width does not meet the specific criteria of the minimum width that we talked about. So you're identifying stocks where, as you can see, we actually tell you what the width, how much premium you're collecting as a percentage of the width, and it's ranked for you from top to bottom. So that's how I found that Merck's trade that I was showing you before, because Merck showed up as an opportunity where the premium or the premium that we were collecting was 39% of the vertical width. And then specifically what we want to do is that we want to overlay that list with stocks that have generated that buy or sell signal. So for example, Merck's has had this nice run up. It's recently pulled back a little bit. So the opportunity is most optimal from a timing perspective to get long, or basically establish a long position through a bullish credit spread using Merck's, because Merck's was collecting 39% of the vertical width. It also had the optimal timing where we were patient in this uptrend, waiting for that pullback and looking for that continuation higher. And then lastly, what we're looking for are only very liquid underlying symbols. The worst thing that we can do is find opportunities in stocks like this where the options are not liquid. So we are doing all the work for you to automate every single step of what I just taught you. If you're familiar with credit spreads, then a lot of this stuff probably already made sense to you. If this is your first time learning about credit spreads, our tool helps you tick all the boxes that I just taught you on what constitutes as an optimal credit spread from an options trading perspective, from a timing perspective, from a liquidity perspective. It's all already done for you, and you can look up these opportunities on your First Trade platform. So just to kind of show you how to access the OptionsPlay tool, when you go to your homepage on First Trade, as you scroll down, there is a button here called Options Wizard. That's how you can access the OptionsPlay tool inside of First Trade. And when you click on it, it will bring up the OptionsPlay platform. And like I said, under the idea section, we have lots of different ideas. We have technical ideas. These are basically buy and sell signals on the underlying security. We have cover calls, we have short puts, and we have credit spreads. So today what we're going to focus on are credit spreads. And what you can see here, as the list that we are showing you is sorted based on how much premium that you could collect as a percentage of the vertical width. So let's take a look at Western Digital here. Western Digital, as you can see, is clearly in a uptrend, right? There's no doubt about the fact that it's currently in an uptrend. And what we look for are these kind of pullbacks in this uptrend for a potential buying opportunity. And that's exactly what we've gotten here in Western Digital. So you got kind of the timing aspect of it. This put spread that we're selling on January 9th, the 155, 140 put spread collects $5.80 on a $15 wide credit spread. So let's do a little bit of math here. $5.80 on a $15 wide credit spread is a little over 38% of the vertical width. And actually, yep. And then let's just look at a few other ones. Let's look at Wayfair. Now, Wayfair is down 5% here today. So you can kind of look at this, and sometimes you might say, that's a little bit too much that the stock has dropped. Maybe this uptrend is no longer intact, that maybe things are starting to fall apart here, and maybe it can break below this moving average and keep moving lower. So I do recommend to do a sanity check on these things before you place a trade. XBI. So, what we look for a lot of times, these pullbacks are quite shallow, right? In terms of the pullbacks. And this is what we got, a bit of a shallow pullback, and the stock is moving higher here. This is collecting $2.90 for a $8 wide credit spread, right? Or sorry, 114, 121. So it's a $7 wide credit spread, and we're collecting $2.90. So $2.90 divided by $7 is 41% of the vertical width, right? So this is for the biotech ETF. So, if you look at this overall chart and you're saying, okay, this clearly is in an uptrend, I think this uptrend can continue. We've gotten a recent bit of a pullback here. That might be an opportune time to enter a bullish position. And now I found a bullish credit spread that's collecting nearly 42% of the vertical width. So now I've got everything that I'm looking for. I've got a very liquid ETF that I know I can execute these trades, at basically the midpoint. I've got the bullish trend. I've been patient within the bullish trend and waited for that small pullback. And I've now identified a credit spread that gives me a really strong risk reward for a credit spread. So it basically ticks all the boxes of what I just looked for. And this is a potential opportunity that I could just click on trade, preview order, and that will also pre-fill your order ticket within first trade, that you can essentially send this off for execution, click on preview, and send this off for execution without having to do any additional work using the platform. So this is really an incredibly powerful tool that we have in terms of helping you understand how to find the best opportunities to help you grow your options account. Regardless of whether you have a small account, a large account, whether you're new to trading or an experienced options trader, it does all the work for you in terms of filtering for these types of opportunities and helping you grow your trading account in the long run. We'll look at one more trading idea just to kind of show you kind of how this all works. Let's take a look at trying to find, maybe let's look at some bearish trades. Let's look at Airbnb. Maybe you feel that the markets are a little bit top heavy and you think it's going to move lower here. Look at the Airbnb. It's in a clear downtrend, right? What we're looking for are these rallies in these downtrends to be a seller of this particular stock. And that's exactly what we've gotten here. We've rallied into that 50-day moving average, and maybe you think that this is now going to be potentially the next leg lower. So now we've kind of identified a good timing on a short here. Now let's look at selling the 120, 128 put spread. That's collecting $3.25. $3.25 on an $8 wide credit spread is 40% of the vertical width, a little bit more than 40% of the vertical width. So you have a really strong risk reward. You've got the right timing. You found it on a very liquid stock, and now you can click on the trade button, preview order, and potentially send this off for execution depending on your account size. Okay, so then let's kind of flip back to a really important aspect of this, because up until now, we've helped you identify the opportunity. But what's more important in terms of your success of growing your account is not just finding the opportunities, but more importantly, sizing those opportunities appropriately for your account size. As a general rule of thumb, the maximum risk that you take on any trade should never exceed 1 to 2% of your total portfolio value. What that means is that if you look at your total portfolio value, let's say you have a $20,000 account, you should not have a credit spread where the maximum risk exceeds $400. There's a few reasons for this. Number one, smaller losses are much easier to accept and let go of. So if, let's say, you put on that Airbnb trade, the trade doesn't go against you, as long as you keep your losses small as a percentage of your total account value, it's easy to accept that, the timing on it wasn't right, or that the trade didn't work out, and you have plenty of capital left to continue trading. But if you start risking 5% of your account every single trade, and all it takes is just a couple of losing trades, and now you've blown such a large percentage of your portfolio that it starts getting difficult to just accept the loss and move on. And that's really, in those scenarios, is when we as traders tend to make some of our worst decisions. When we feel that we're cornered and we've lost too much money, we get desperate and we do things many times that are counterintuitive or counterproductive to the growth of our accounts. That's when we throw good money after bad money. That's when we don't take losses when we should. And that's how we many times blow huge holes in our portfolio. So keep your trades small. That's going to help you stay disciplined in your trades. And ultimately, the goal is to prevent you from blowing up your account. As long as you don't blow up your account, you can trade another day and get back to break even. If you blow up your account, you have no shot ever at getting yourself back to break even. So it's all about making sure that you never, ever, ever blow up your account, because as long as you don't blow up your account, the upside opportunity is there. But as soon as you blow up your account, there is no upside opportunity left at all. And that is what is arguably one of the most difficult things about trading, is that there's a finite amount of capital that you can lose. There's an infinite number of capital that you can potentially make. So it's about making sure that you don't blow up your account. As long as you don't blow up your account, you're still in business and you can potentially continue trading. So lastly, what I'll leave you with is just a comment on how to manage these trades. There are generally 3 rules as to how to manage a credit spread. There are 3 triggers that can potentially trigger a closing position on a credit spread. Number 1 is a stop loss order. And this is the most important one. Meaning if let's say you don't have the time to look at all your positions every single day, I recommend that you place a stop loss order on your positions, so that at the very least you can potentially be protected to the downside. Now, the strategy has a maximum risk anyway, so you are protected from that perspective, but it's still better to be protected even further by using a stop loss order. And the general rule of thumb is once you lose 100% of the maximum gain potential, it's time to cut your losses. So what that means is that, let's say you have a credit spread here and you've collected $8 on that credit spread. The rule of thumb is that you want to place a stop loss order at $16 to get yourself out, because the maximum gain potential on an $8 credit spread is $8. So if an $8 credit spread loses $8, meaning when it's something that you sold for $8 is now trading at $16, you've lost $8 on that trade. It's time to cut your losses and move on. You could potentially lose up to in this particular case, $12, because the maximum loss on a $20 wide credit spread minus the $8 is $12. But we don't want to lose $12 if we can cut our losses at $8. That's the goal of the stop loss order, because once you've lost $8 on a credit spread, your chances of losing the full 12 is pretty high. So at that stage, it's better for you to basically cut your losses, save the $4 that you can potentially still lose further from losing that towards your next trade. You're better off doing that rather than just holding onto a trade, hoping that's going to come back when the chances of you losing the other $4 are relatively high. On the flip side, when the trade gains 50% of its maximum gain, that's when you want to start taking profits. So if you sold something for $8, once it makes 50% of the maximum gain potential, you want to start taking profits. Now, taking profits doesn't mean that you take profits and you walk away. Taking profits many times means that you take profits and you basically sell a new credit spread. You go out another 45 days and you recenter the strike prices based on where the stock has moved. And this way, what that means is that you're just constantly collecting or locking in some profits, but you're still maintaining that upside exposure in the stock, right? So the whole point is to make sure that you have the upside potential, but keep locking in profits as you go along. And the third rule of thumb when it comes to credit spreads is that you want to exit at 21 days to expiration because you're selling an at the money put option or an at the money call option. Those have higher risks of early assignment. So the way to avoid early assignment is to make sure that you roll these well before expiration. These are typically strategies you don't want to hold into expiration. So it's all about making sure that you remove that early expiration risk. And by doing so, what you're able to do is to avoid that early assignment risk. So if you have a credit spread that's approaching 21 days to expiration, you want to also consider rolling that trade at that time as opposed to holding it to expiration. So those are the rules that we generally have in place for managing a credit spread. So with that, that covers what I wanted to share with you here today. I hope that that's helpful in giving you a better understanding of this one strategy that's incredibly versatile and flexible for a lot of different traders of 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 experience levels, of account sizes that I think should be in the toolbox of every single options trader that's interested in growing their accounts in a consistent fashion in being able to identify some of the best opportunities in the market using these tools that are available at First Trade. With that, what I'll do is I'll open this up for Q&A. There's a Q&A button at the bottom of your screen. If you can type your questions if you can type your Q&A session questions there, I can answer your questions in the Q&A section. Any questions regarding credit spreads or how to use the tools here at First Trade? One question is, given a credit spread, it's best for short-term profitability to trade a higher volatility ticker. Not necessarily, right? Because you're both buying and selling in a credit spread. So yes, it makes sense to sell something when it has higher volatility, but then you're also buying a strike. So you're also at the same time buying something that has even higher volatility. So it's not necessarily that just high volatility stocks are best for this, because what you're doing is you're trading kind of the skew between the strike that you're buying and the strike that you're selling. So you're really looking for skew rather than just high volatility or low volatility. So I wouldn't quite say that is um, uh, the only opportunities that you can find is in high volatility tickers. Do you get out of both legs or one at a time? You get out of both legs. So whenever we talk about these vertical spreads, you always trade them as one strategy, meaning you get in both legs at once and you get out at both legs at one time. You never break them up as a strategy. Can you explain when to choose calls versus puts? Yeah. So whenever you're buying, calls are bullish, puts are bearish, right? But when you're selling, it's the opposite. Puts are bullish, calls are bearish. So the tool automatically identifies this for you, right? So whenever we look at this tool, it'll automatically select the correct calls and puts for you. It selects everything for you. It selects the expiration date, the strike prices, everything based on the best practices that I taught you, right? So for example, when we go to this credit spread, right? And At Airbnb, when we looked at selling the January 120, 130 call vertical, it's automatically selecting that 45-day expiration. So as you can see, there's 44 days to expiration. We're selling the we're selling the 120s, right, which is the at the money call, and we're selling the 130s, buying the 130s, which is a 24 delta, right? Our target is 25 delta. So this automatically selects for you the correct expiration date of the correct strike prices and only identifies it when the risk to reward ratio is favorable to you. So it does all of that work for you. So for example, you see it'll say WDC bullish put, bullish put, bullish put, and then if you look at Airbnb, it'll say bearish call, right? So it automatically does the work for you of selecting the appropriate calls and puts, the expiration dates, and even the strike prices. Great question. It's saying, would you trade the strategy in around earnings? So look at every single opportunity. You see, there's a little button here. There's a little notation here that says earnings yes versus earnings no. It tells you whether or not there's going to be earnings between now and that expiration date. It's from my perspective, I feel comfortable trading these around earnings because it has defined risk, right? No matter what happens, even if the stock goes in the exact opposite direction that you thought it was going to be and just takes off in the opposite direction, you have limited risk in these strategies. So because of that, I feel comfortable trading these around earnings. But I do think that you should take when something has earnings, you should take that into account and look at it a little bit further before you decide whether it's something you want to trade. Because not all earnings are the same, right? Like if it's in Tesla or Apple or Tesla or I don't know, Palantir or something like that, where the stock can really move, maybe I think about that a second time or decide whether or not I think that earnings will go in the direction of my trade, right? Versus if you're trading something like Pepsi or Coca-Cola or McDonald's, generally those stocks don't move that much on earnings and they tend to be fairly predictable. Those are the ones that you might be more inclined to trade around earnings. So it depends on kind of your own risk tolerance, but generally speaking, earnings is not an issue, but our tools do tell you whether or not there's an earnings coming up or not on these opportunities. What is meant by high implied volatility? So it just is looking at the volatility of we look at IV rank. IV rank is a good indicator of whether the options are relatively cheap or expensive. Um, um, so IV rank of 10 means that the options are relatively inexpensive relative to the highs of the previous 52 weeks. So an IV rank of 100 means that the options are the most expensive it's been over the last 52 weeks. An IV rank of 0 means that it's the cheapest it's been over the last 52 weeks. So an IV rank basically helps you measure how cheap or how expensive the options are relative to its 52-week history. So high implied volatility is usually referring to an IV rank that's greater than 30 to 40%. We usually consider as high implied volatility. How do you screen the proper candidate ticker? I'm not sure I understand your question. Screen it from what perspective? Can these opportunities be found directly on OptionsPlay or only through First Trade? They can be found through both. But the value of First Trade is that First Trade is offering you this platform for free as part of your First Trade brokerage account. If you go through OptionsPlay, you would have to pay for it. This First Trade allowed trading credit spreads in an IRA account. I'm unfortunately not capable of answering that question. Since I don't work for First Trade, I work for OptionsPlay. You would have to direct that question at your First Trade representative to help you understand that. No, the system does not automatically select any stop losses or take profits. You have to calculate that yourself. What would you consider how big the bid-ask spread might be? Yes. So when we say we consider liquidity, what we mean by that is we're looking at the bid-ask spread of the strategy. So as you can see, this is trading at 353 to 352 by 372, right? That's the bid-ask. That's a pretty tight spread for a $120 stock. We are factoring that in when we look at liquidity. What is the significance of relative strength? Relative strength tells you how the stock is performing relative to the market. Generally speaking, if you're bullish on a stock, you generally want to see strong relative strength, or at least improving relative strength. And then if you're bearish on a stock, you generally want to see poor relative strength, or at least deteriorating relative strength. So it's just another indicator to give you a sense for how strong is the momentum of a stock. If the stock is moving higher, how strong is that momentum, right? Is it just moving higher at the same pace as the market is, or is it moving higher at a pace that's faster than the market? Or if it's declining, is it declining at a pace that's at the same pace of the market or even faster than the market? So that's what relative strength tells you. Is it better for a credit spread or a debit spread? One is not better than the other. They're used for completely different it's used for completely different opportunities. A credit spread is a mild directional view that you can trade, that even if the stock just stays sideways, you can be profitable on. Debit spreads are for when you think the stock's going to make a big move, because if a stock doesn't move and you buy a debit spread, you're going to lose money. But if the stock makes a big move, you're going to have a really strong risk reward ratio. So you can't compare the two, because they're used for completely different outlooks. Your question of why did we choose Airbnb? Because Airbnb satisfied all the requirements. It has a strong credit spread. It also has the right timing, right? So we have a bearish trend. We've looking for these rallies in the bearish trend, and it's liquid. So it checks all the boxes for an optimal credit spread. So only when something meets all the requirements does it become one of these 40 opportunities in the credit spread box. How important is volume? Generally, well, here's the thing: is that we are only selecting very liquid symbols, where volume is sort of it's not you're all of these stocks that you're going to find in these credit spread opportunities have sufficient volume. Volume's not going to be an issue. So generally speaking, we don't factor in volume because of how liquid these opportunities are. I believe in bearish, we used a bear call spread. That is correct. Any other questions? Is the criteria adjustable? No, these are hard and fast rules that are not adjustable. One, because this is um a strategy that has been back tested and battle tested and has been um proven to be successful, and that's why these criteria for specifically finding these opportunities are set in stone. With that, thank you so much. I hope you guys have a great trading day. I hope this is helpful in giving you a better understanding of the strategy, and more importantly, helping you understand the tools that are available to you here at First Trade that can help you identify trading opportunities for this specific strategy that gives you a specific edge on both the options and the timing. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.